Corporations are separate legal entities incorporated in the states of their origin, be it Texas, Delaware, Oklahoma. They are issued by the Secretary of State of that individual state, and they are separate legal entities. They can buy and sell property. They can be dissolved, they can sue, they can be sued, they can do everything that an individual citizen can do with the notable exception of voting. Corporations make up 90% of the revenue, while only making up about 10% of the entities. The owners, in exchange for their common stock, are shareholders, and they buy this stock in order to exercise control over these entities. So the two main categories of stockholders' equity are paid-in capital, and this is known as contributed capital. This is the amount that the stockholders have given in exchange for their shares of stock, be it cash or other valuable assets, and that makes up the contributed capital. Most stocks have a par value, so the number of shares times that par value gets put into that account, known as common stock, and then the rest of it that is exchanged for those shares over and above the par value goes into an account called paid-in capital in excess of par. These two main accounts that make up contributed capital are added to retained earnings, and that is the total for stockholders' equity. And retained earnings, as we know from the first chapters, are calculated by taking the beginning retained earnings, the amount that was left over from the prior period, add in net income for the current year, subtract any dividends, and that will give you the retained earnings at the end of the year. Stock issues are authorized and defined by the board of directors, and they have three important numbers. They have the total shares authorized. This is the entire amount that can be sold to the shareholders. They have the amount that are issued. Those are the ones that are actually sold by the corporation to the shareholders. And then lastly, there are the number of shares that are still outstanding, still being circulated amongst the shareholders. And the difference between those two is a characteristic known as treasury stock. So a corporation like Boeing or Apple can go out into the marketplace and buy up shares of their own stock, and that will reduce the amount of shares outstanding, and it is a technique that is utilized sometimes in order to keep the price per share up, because the less shares that are outstanding and circulating, the higher value per share there is. The other characteristic is, as I mentioned before, many states in the United States require that a share of stock have a par value. This is often very de minimis, $1, $10, sometimes a dime, or even a penny. There are some states out there that do not allow you to sell a share of stock for less than its par value, so that value is often kept very, very low. Additional paid-in capital is when the market value of a share of stock exceeds the par value and is sold to a shareholder. The amount that is over and above the par value on that individual security is then put into a separate account called additional paid-in capital or capital paid in excess of par. Treasury stock, as I mentioned before, is the amount of stock that is repurchased and reacquired by the issuing corporation. There are common stock. All corporations have at least one class of common stock. And this is the votes. These are the shareholders that get to vote in electing the board of directors and at annual meetings. They have rights to earnings in the dividends that are authorized and distributed, and they have a right to the share of assets in the case of liquidation, bankruptcy. So the other type of stock is a preferred stock, and that is oftentimes a special type of security that is sold by a corporation. They have the right to receive dividends before common stock. Oftentimes their dividends are guaranteed them as a percentage of the total par value of the preferred stock, which oftentimes is higher, $100, $250 in those ranges, and they stand in line first. They get their payments before the common stockholders. Dividends are a return of earnings back to the shareholders. The important dates on dividends is the date that the board of directors states that the dividend is authorized. Then there is a date of record. That is the date in which whoever owns the shares of stock, whether it's common stock or preferred stock, receives the dividends. This is oftentimes much later than the date of declaration so that they can get all the paperwork in order to determine who owns the stock at that particular date. And then there's the date of distribution. So those shareholders that own the stock on the date of record will then receive the checks of the dividends. So this is what the shareholders' equity section of the balance sheet looks like. It's broken into two main categories, the paid-in capital and retained earnings. The preferred stock is listed first, and you see this is a 10% preferred stock, a $50 par, so they're guaranteed a $5 dividend on an annual basis, and there are 2,000 shares authorized and issued in that case. And then there is the excess issue price over par, so that 10,000 represents the amount paid in excess of the $50 par. Then the common stock has a $20 par value. 50,000 shares authorized, only 45,000 shares are issued. And there is the $190 excess of issue price over par for paid-in capital in excess of par. They also have $2,000 from the sale of treasury stock that is listed there separately. So these are common stock shares that had previously been purchased by Telex Inc. and then sold back to the general public. And then lastly, after retained earnings, you can see that there are still 600 shares at cost of treasury stock owned by the corporation. So those are the way that is represented, and you can see that in the top and the method 2, method 1 and method 2. Method 1 is just a little bit more detail. Lastly, we'll post separately a YouTube video that simplifies the stockholders' equity so that you can go through and further study this particular area of the balance sheet.